Hello, good evening everyone, and welcome to this evening's webinar session where we'll be going back to the basics of trading the financial markets. So today we're going to look at how you can form a solid base or solid foundation to becoming a successful trader. But before we start, we need to first differentiate between trading and investing. It's very important to have a clear understanding of what trading is and what investing is, because trading is significantly different from investing. Because when you're trading, you need to think like a trader and behave like a trader. And when you're investing, you need to think like an investor and behave like an investor. Very important. So you have to remember that trading is short term, in and out of the market, short term, and investing is long term. So with trading, you're looking to make gains in the market within a couple of seconds, a couple of minutes, couple of hours, couple of weeks, couple of months. Whereas with investing, you're looking at 10 to 20 years. So they're vastly different. So trading is short term, investing is long term. So the mindset of a trader is different from a mindset of an investor. Very, very important. Now, this is a famous quote from Warren Buffett, who is the richest investor in the world. And he says, risk comes from not knowing what you are doing. Because most people, when you talk to them about trading and investing in the financial markets, all they think about is how risky it is, how people have lost money on the markets. But the problem is that the vast majority of people who get involved in the financial markets do not know what they're doing. They don't know how to assess the markets, they don't know how to trade, they don't know how to invest, they don't know the basics of trading or investing in the financial markets, and that's why they lose money. So risk comes from not knowing what you're doing. But if you know what you're doing, you follow the rules, then it's not as risky as one makes it out to be. The other thing we need to clarify and differentiate is what are these financial markets we talk about. Because again, people use the words loosely. They talk about trading the financial markets, investing in the financial markets. This is happening to the financial markets. But what are the financial markets? Now, the financial markets comprise of four major components. Four major components. So we have one, the fixed income securities market. That's one major part of the financial markets, is the fixed income securities market. And the fixed income securities is what you call the treasury bills and the bonds. So bonds and treasury bills fall under the fixed income securities market. Then the other major component of the financial markets is the stock market itself, the stock market where you buy companies, stocks, and shares. So that's another major component of the financial markets. And then you then have the currency or the forex market where you're trading currencies. And then finally you then have the commodities market, things like oil, gold, coffee, wheat, etc., etc. So these are the four major components of the financial markets. The fixed income securities market, stock market, currency market, and the commodities market. So there are four different markets that comprise the financial markets, and obviously you can see they are different markets. Because the fixed income securities market is different from the stock market is different from the currency market, and the currency market is different from the commodities market. So it's very important to realize that these are four separate markets that comprise the financial markets. And the reason why that's important is that, for instance, if you're trading the currency market, it's different from the stock market. When we had the stock market crash in the 2008-2009, that was the stock market that was crashing, but the commodities market, such as oil, was going up. So you can see that they can move in different directions. So that's why it's important to realize that these markets are four independent markets that comprise the financial markets. Now, the other reason why it's important to realize that four separate markets that comprise the financial markets is in relation to investment risk. Because when you're approaching the financial markets, you need to first decide what is your risk appetite. What is your risk appetite? So investment risk is very important. Now, low risk and risk you could just remember as your chance of losing money. Let's just keep the definition of risk nice and simple. So risk just means your chance of losing money. That is what risk is about, your chance of losing money. So when you see low risk, it means there's a low chance of you losing money. Okay, so that's low risk. Low risk means low chance of losing money. So if you're the sort of person who will get depressed over losing, $1, if you get depressed over losing $1, or you're very upset or scared of losing $1 or 1 cent, then you have a low risk appetite. So if you have a low risk appetite and you don't want to lose money, then the best market to invest in is the fixed income securities market, where you buy bonds and treasury bills. So that's low risk. Very important. And you can get returns, especially in a country like Nigeria, you can get returns of about 13.5% a year on bonds and treasury bills. In Ghana, you can get up to 24% on bonds and treasury bills per year. In UK, it's about 0.5%. Same with USA and Japan. So you can see the annual returns on bonds and treasury bills differ with different countries. But you have to also assess the risk of the country. So that's why it's called low risk, not no risk. So it's low chance of you losing money, but I didn't say no risk. So there's still some element of risk. You need to assess the bonds or the treasury bills you're buying properly. And of course, this is not the forum for that. We'll be discussing bonds and treasury bills in the future in detail. So it's low risk, and the best market for that is the fixed income securities market. Now, if you have some element of risk appetite and you don't mind taking a bit of a risk on the markets, so which comes to medium risk, then the best market to do that is the stock market, and it's long-term investment in the stock market. The key word there is long-term investment in the stock market. So you can say I didn't say trading, I said long-term investment in the stock market. So if you invest in the stock market for 10 to 20 years, the risk of you losing money is a bit low, is medium. And, the stock market, 2013 returned almost 40% annual return. So you can see as the risk goes up, your returns go up. And then you can also come to high risk. So high risk means high risk. High risk just means there's a high chance of you losing your money. So never ever forget that. When it comes to high risk means there's a high chance of you losing your money. So if you're risk adverse and you're scared of losing money, then trading is not for you. Trading is not for anyone who is risk adverse. If you're scared of taking risk, you're scared of losing money, then you should not be trading. Trading is high risk. That means there's a high chance of you losing money. And the best market to trade is the forex or the commodities market, where you can get 100% or more annual return. So although you can get 100% plus annual return, but don't forget it's high risk, so you could also lose all your money. So it's high risk. But as we'll touch on soon, you can mitigate this risk or manage this risk by learning the rules of how to trade properly. So that's on investment risk. So you can see low risk. If you have a low risk appetite, best market to invest in is the fixed income securities market. If you have some amount of risk appetite, you can do long-term investment in the stock market. That if you have a high risk appetite, then you can go into trading the forex or the commodities market, and that's what we're talking today. Today we're talking about the basics of trading the financial markets. So what are the basics of trading? Which is what we're focusing on now, is the basics of trading. Now, trading, as we know, offers you an opportunity to create another stream of income with good cash flow. Once you have developed your mindset sufficiently and learned the rules of trading. So there are rules to trading. As with anything, if you want to do well, you need to learn the rules. So again, I always warn people that you should see trading as part of your multiple income stream. So trading will be in addition to your investing or other things you're doing, or other businesses or other income streams you have. So trading offers you just an opportunity to create another stream of income with good cash flow, but it's very, very important you develop your mindset sufficiently and learn the rules of trading, which we're going to touch on these rules of trading. Also, trading may involve heavy losses because it's high risk, but this can be minimized with the development of a good trading plan. So you need to have a good trading plan in order to be successful. So to become a successful trader in the financial markets, you must possess what we call the 3 M's. If you apply the 3 M's to every single trade you place, your success as a trader is guaranteed. I'll repeat that because this is very important, and this forms the basis of trading really. So to become a successful trader in the financial markets, you must possess what we call the 3 M's. And if you apply the 3 M's to every single trade you place, your success as a trader is guaranteed. If you miss 1 M out, your failure as a trader is guaranteed. It's as straightforward and as simple as that. You apply the 3 M's to every single trade you place, your success is guaranteed. You miss 1 M out, your failure is guaranteed. So what are the 3 M's? Here are the 3 M's. The 3 M's are mind, money management, and method. So the 3 M's again: mind, money management, and method. And the most important M is the mind. 95% of your success as a trader is down to your mind. The proper term for mind is trading psychology. So that's a proper term for mind. If you're looking at going to do some more research or reading on the mind, what you'll be looking for is trading psychology. So a disciplined mind is an absolute requirement for successful trading. The next important M is money management. This is crucial. Money management. This is possibly the most important factor in trading. And your first goal of money management is survival. You want to survive to trade the next day. So you need to avoid risk that can put you out of business. So that's your first goal. The second goal is to earn a steady return. And the third is to improve on the second. So money management is very, very important in trading. If you don't apply good money management as a trader, you won't survive very long as a trader. So it's a very crucial part of trading. You need to understand and learn how to apply money management to your trading. And again, this is a topic we'll be touching on in detail in subsequent webinars. So money management is the second important M. And the last M is the method. So the method is the last M. It's the least important. It is important to have a method, but it's the least important. So you must have a plan or a methodology to your trading, which should not be based on tips, hunches, visions, or dreams. You should have your own plan. You should have your own method of approaching the markets and how you trade. So it's very important to have a method of how you trade. So that gives you guidance and discipline and consistency in your trading. But the most important M's are the mind and the money management, and the method is the least important. It's still important, it's still part of the 3 M's, but it's the least important. And unfortunately, most traders tend to focus on the least important M, the method, instead of focusing on the most important ones, the mind and money management. Because things like, computer softwares, robots, signals, trading strategies, indicators, all that fall under method. They all fall under method, and they're the least important part of trading. Like I say again, it is important to have a method. It's important to have a plan of how you approach the markets, how you trade, and to have a strategy. But it's nowhere as important as the mind and money management. Now, a few questions for you to ask yourself. Why do we trade? Why do you want to learn how to trade? Very important question to ask yourself. Why do you want to learn how to trade? We're going to answer all these questions, but it's food for thought. Why do you want to learn how to trade? When should you be trading? Should you just trade anytime, on any day? So another question to think about. When should you trade? How do you trade? Or are you just going to guess on how to enter the market? So we'll start again. Why do you want to learn how to trade, or why are you trading? Very important question. When should you be trading? What time of the day, what day of the week? How do you trade? So how do you approach the market? What are the tools required for trading? So what tools do you need to trade the markets? And how much do you need to trade? So how much do you need to get started with trading? So these are a few questions for you to just think about. So we'll start with, why do we trade? So why do you want to learn how to trade? Now, people trade for many reasons. The many reasons why people want to learn how to trade, or why they trade the markets. Some people, trading offers an opportunity to make a quick buck, which symbolizes freedom to many people. You want to be financially independent and not working for anybody. So trading can offer you that. Trading means one can become their own boss and determine his or her own destiny, provided you're trading right, so you're trading the right way. But for some people, people trade for the excitement and the adrenaline rush, because it involves pitting our wits against the very best, which can be challenging and exciting for the risk taker. So you can see people trade for a variety of reasons. But like I said earlier, trading is definitely not for the risk adverse. If you're risk adverse, you should not be trading, because like we said earlier, it's high risk. Very important to always remember that, and I'm going to keep emphasizing that trading is high risk. So if you're risk adverse, you should not be trading. It's definitely not for the risk adverse. Now remember that trading well will make you money. Trading well will make you a lot of money. And trading well means applying the 3 M's, applying the mind, money management, and method. So trading well will make you a lot of money. But if your aim is just to make money, rather than trading well, you may lose an obscene amount of money. So your focus, and the only reason why you want to be trading, is to be a good trader. So that should be your sole purpose for wanting to learn how to trade. So you should want to learn how to trade so you can become a good trader. And a good trader applies the 3 M's. And that should be your sole focus, not on making money. So your focus should not be on how you're going to make money. Your focus should be on being a good trader, and a good trader means applying the 3 M's of mind, money management, and method to all your trades. Because if you do that and you trade well, you will make money. But if your aim is just to make money rather than trading well and applying the 3 M's, you may lose an obscene amount of money. So traders who trade for the excitement and the thrill are liable to take trades with bad odds and accept unnecessary risk and tend to lose a lot of money. So you shouldn't be trading for excitement. It's not a game. You shouldn't be trading for thrills. You know, it's not a game. Like I said, your aim should be to be a good trader and focus on applying the 3 M's. Very, very important. And that's why, you know, people lose money in the markets, because the markets are unforgiving and emotional trading will result in heavy losses. The markets do not care who you are, your social circumstances, your financial circumstances. The markets don't really care who is trading. So they are unforgiving, and if you trade emotionally and in a disciplined way, then you will get hurt by the market and lose a lot of money. Very, very important to remember that. So when should you trade? When should you be trading the markets? So before you trade, you must examine the market conditions adequately in order to assess when to trade. So you need to learn how to assess the markets very well, decide whether there are good conditions available for you to trade before you trade. Okay, so you must examine the market conditions adequately. Now, an irresistible urge to just execute trades is no different from gambling, in which case you may consider joining your local chapter of Gamblers Anonymous if you can't stay away from trading. So again, trading is not gambling. You shouldn't just be getting in and out of the market for no reason. You always have to have a good logical reason to enter the markets and also exit the markets and apply money management. So if you're just having an irresistible urge just to keep executing trades, then you're just gambling really. So successful trading implies trading when the odds are in your favor. So that's all you're trying to do as a trader, is to stack all the odds in your favor. You know, making sure that you've assessed the market properly, everything is in your favor, and then you go ahead and trade. Again, just going to remind you, we're just talking about the basics of trading, the things you need to do to become a successful trader. But obviously, if you do want to go into detail of how to become a successful trader and learn the ropes, it's also advisable for you to attend our master classes. We do a 2-day master class where we go through to you in detail the theory and the practical side of being a successful trader. But here we're just going through the basics, and obviously some of these topics again we'll touch in detail at the live trading seminars in subsequent weeks. So continuing on when should you trade, like I said, although you may have a brilliant trading system or a method of how you trade, but if you feel frightened or upset, your account is likely to suffer. So again, this goes back to the mind and your emotion and your mindset and how disciplined and emotionally controlled you are with trading. Because the mind, like I said earlier, comprises 95% of your success as a trader. So it's your ability to control your emotions, be disciplined, be consistent, goes a long way to becoming a successful trader. So you can't afford to be emotional when it comes to trading. So like I say, your success or failure as a trader is dependent on your ability to control your emotions. Very important. So in addition, you should avoid trading when important news is due to be broadcast. So you always check the economic calendar. So as we know, if there are reports of high importance due out, you want to avoid trading prior to that report due out. So again, it's you knowing that you can't just trade anytime, and you need to check the economic calendar and avoid trading prior to reports of high importance. So what are the rules of trading? So according to Warren Buffett, the world's richest investor for many years, there are 2 rules of trading and investing. So rule number 1, don't lose money. That's rule number one, according to Warren Buffett. So that's the first and important rule. Don't lose money. Don't lose money just means you need to focus on your risk management and your money management, making sure you're risking the appropriate amount of money on the trade. Make sure you're picking your trades right and not just jumping in and out of the market. So you want to do as much as possible to limit your risk and not to lose money. And rule number two is don't forget rule number one. So you must remember that trading in the right way with the 3 M's in mind, money management, and method, will make you money. However, if your aim is just to make money rather than trading in the right way, this may result in the loss of an obscene amount of money. So like I said, your sole focus should be on learning how to trade well. And trading well means applying the 3 M's of the mind, money management, and the method. And like I said, these 3 M's will be discussed in detail in subsequent webinars. So how do you trade? Very, very important that no trades must be placed without having an exit strategy. Again, like we said, trading is different from investing. As an investor, you're looking to buy and hold for many years to come, 5, 10 years. But as a trader, you're looking to get in and most importantly, get out of the market. So as a trader, you must always have an exit strategy prior to placing your trades. So no trades must be placed without having an exit strategy in terms of where to cut your losses or where to take your profits. It's not during a live trade that you then decide where to exit that trade. You need to decide where to exit before you place the trade. So we also all go through losing streaks, but it's imperative that your positions are kept small during losing streaks. As we found out with this Greek situation, the problem with the Greece and the Eurozone at the moment, I think for the last 4 or 5 weeks, the last 4 or 5 weeks in the markets have been dominated by the Greek issue and the Greek debt, the possibility of Greece leaving the Eurozone and the impact on that on the Eurozone and the Euro dollar. So this has caused a lot of uncertainty in the markets over the last 4 or 5 weeks. So a lot of traders, including myself, have been going through a losing streak. But this is the time where you need to keep your position small, limit your risk, be careful how you trade. Because again, this is not unusual when it comes to trading. You can have losing streaks, and this is where your mind and your money management comes into play. But under no circumstances should one trade put your whole account equity at risk. This is very, 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 very important. No one trade should put your whole account equity at risk. You shouldn't be blowing your whole account on one trade. So you need to treat trading like a business. Nobody starts a serious business without the business plan. So as a trader, you have to have a trading plan, because a trading plan helps you in terms of how you approach the market, where you enter the market, when you trade, when you exit the market, and all that. So it's very important to have a trading plan, because a trading plan makes you consistent and disciplined. And again, a trading plan is a topic we'll be focusing on in much detail in subsequent webinars. So here are some special points of interest. I should remember that directors may lie of companies, so don't always believe what directors say on the news. News forecasters may lie too, so don't believe everything you hear on the news. Brokers may lie, so be careful. Accountants may cook the books, like we know with Enron, but the charts never lie. And it is no secret what the charts tell you. So technical analysis is very important in trading. So as a trader, it's very important to learn how to read charts, learn about technical analysis, because it gives you an added advantage as a trader if you know how to read charts and you know technical analysis very well. So always remember that the charts never lie. So it's no secret what the charts tell you. The charts will tell you what's really happening in the markets, whether the markets are really going up or really going down. So what are the tools of trading? What tools do you need to trade? So once you have determined that you want to become a trader, there are a few things you need to get started. Number one, you need a personal computer with good memory, at least 2 gigabytes, and at least a dual-core processor. So that's the minimum you need. Obviously, you can get more than that, but that's the minimum. You need a good memory with at least 2 gigabytes and at least a dual-core processor. Obviously, you need internet access, ideally broadband, so that because you need fast internet, especially when it comes to executing your trades or reading the market. So internet access, ideally broadband. Pen and paper to make notes, especially if you're new to trading. You need to have a pen and paper by your side so you can make notes of what's going on in the markets, note down observations you're making in the markets. And that's it really, that's all you need. And obviously you need money to trade with. So it's advisable to start with about $500. So you can start with about $500 and that would be a good start in your trading career. So that's all you need in terms of your tools of trading. So you have to remember you need to keep on educating yourself, as we do in our professions. So in any profession, if you want to get better and better and you want to improve in that profession, you keep going for courses, you keep reading, you keep practicing, and it's the same for trading. If you want to be a very good trader and a very profitable trader, you need to keep educating yourself, keep going for courses, keep reading, keep doing your own private study, keep practicing, and that's the only way you can become a successful trader. So trading is like any other profession, requires discipline and diligence. You're not going to start trading today and become a very good trader overnight. That just won't happen. The only way you can become a good trader and a very profitable trader is just through practice, through reading, through study. That's the only way. There's no magic to it. It's just hard work and dedication, discipline and diligence. So we all need to do research before putting in trades. Before you place a trade, you need to do the research, assess the market, check the market conditions, check the economic calendar, know whether it's a good time or not to trade before you put in your trade. And like I said earlier, you need to attend trading seminars and workshops, which we as dkbMARKETS, we run trading seminars and workshops which you can be part of. You also have to have an allocated time to trade. This is very important. You should consider trading a serious business and treat it like one. So when you're going to trade, you need to allocate time for that trading so you're not disturbed, so you can concentrate on what you're doing. So like any other business or job, you want to be free from distractions such as friends, telephones, TVs, anything that will distract your concentration and your focus on your trading. So you need to have that allocated time. As you'll find out as a trader, there are quite a few decisions that need to be made while you're trading, and so you need to be fully focused on your trading. Otherwise, bad decisions will be made, and bad decisions will lead to you losing money. So you need to be careful about that. So like we said earlier, you also have to have a trading plan. Very important to have a trading plan. You must develop a personalized trading plan, because without a trading plan, you are setting yourself up for failure. Absolutely crucial for you to have a trading plan. And like I said, again, we'll be discussing this in subsequent webinars. And also during our 2-day masterclass, we also teach you how to devise a plan for yourself. Now, it's not only important to have a trading plan, but most importantly, you have to be disciplined and stick to your trading plan. There's no point having a plan if you don't stick to it. So very important you stick to it. So obviously, to start trading, you need to open a trading account. You need to have a trading account to trade with. That's the only way you can access the market. So it's now very easy to open an online trading account. Obviously, we at dkbMARKETS, we have an online trading platform, and we partner with industry professional traders and platform providers who operate in London, Europe, and Australia. But the dkbMARKETS focus is to provide a dedicated service in Africa. So with dkbMARKETS, you can always open an account, and that we will then give you access to the global markets. So for details, you go to our website, www.dkbmarkets.com. on how to open a trading account and details of how you two can start trading and have access to the markets. So like I said, as a trader, you need to do some studying of your own. You need to start to read about the markets, read about trading, and most importantly, start to understand some definitions and terminologies in trading. I'm just going to give you an example of a few. So it's like homework for you. So this is some homework to get you studying and to get you reading. You need to know what an uptrend means. You need to know the definition of an uptrend. You need to know the definitions of a downtrend. An uptrend means when the market is making higher highs and higher lows. A downtrend is when the market is making lower lows, lower highs. You need to know what bulls are. The bulls just means when the market is going up. You need to know what bears are. Bears just mean when the market is going down. You need to know what a market support is, what a market resistance is. You need to know what indices are, what position trading is, what swing trading is. So basically, when you hear all these terms being branded on the TV and the newspapers about the markets, you need to go and read about it, understand what it means, understand all these terminologies, so you understand what they're talking about regarding the financial markets. Here are some websites that are very helpful, good resource for you to learn about the markets. One is marketwatch.com. It's an up-to-date financial website that's updated every couple of minutes. So it gives you up-to-date information on the financial markets. Same as thestreet.com. It gives you market information. Moneyshow.com is also another good site where you can get to watch interviews and from traders around the world, and also get information on the market from around the world. So moneyshow.com, another very good website. Stockcharts.com, also you can get a lot of information on stock charts about the markets. And babypips.com, that's another good source of information on the markets. So these are quite good resources to get started with, along with others you can find yourself, in terms of getting information, studying the markets, reading some theory about the markets. Okay, so basically that's the basics of trading the markets. Really, like I said, the main thing is to remember the 3 M's of the mind, money management, and method. Those are the 3 M's that will see you through to becoming a successful trader. Like I said, those 3 M's will be going through them in detail in subsequent weeks. We'll be going through in detail about the mind. We'll be going in detail about the money management and how to apply it, and also the method and how to devise a trading plan in subsequent weeks, as we build up to the 2 weeks live trading sessions. Okay, any questions? If you have any questions regarding the basics of trading, do click the hand button on your control panel or send your questions through to the question box. So if you have any questions, do click the hand button. So I guess the presentation was as basic as it said, straightforward and basic. So okay, so if you don't have any questions, I wish you all a good evening, and we'll meet again next week, Tuesday evening. So have a great week. Remember to apply the 3 M's, and happy trading. Take care. God bless.